And we're back. um, Hi, Nelson. How you doing?
I'm stupendous. How are you?
You're doing better than me. That's for sure. So we're back with the owner and writer of the Canadian Dividend Investing newsletter. That's what it's called, right?
Yes. It always cracks me up when one person, like operations, when they say, like, I'm the CEO of that publication. So thank you for not calling me the CEO because I've always felt that's a little bit cringe.
As someone who's like a multiple business owner and has been since I was young, I also feel. See, it's in the Facebook movie where he does the like I'm CEO bitch on his business card or whatever. That's what it's giving when like yeah. Even though I am basically in a CEO role, I still don't use that. I usually use director nowadays in
Ooh.
my old age. That's what I kind of say on my business cards and stuff. But yeah, so we are here. I have been liking to kind of talk to people that are knowledgeable in certain topics when I kind of have questions. So we're here to talk about a specific company today, which is the Exchange Income Corporation. So I want to kind of dive into a few different things, kind of the context behind the company, how they were founded, their management team, and then the kind of the style and structure of the business. And then I'm sure we'll get sidetracked through there as well. So I guess we can start with my kind of experience with Exchange Income Corp, BIF ticker on the TSX, and I think they're cross listed somewhere else as well. Last time I checked, in the United States somewhere.
I think it's on the over-the-counter exchange
Mm,
in the US.
okay,
Sorry, we're
and
being interrupted here.
and yeah, so my experience, I'll play the clip in the edited version. A couple years ago, I was on the Newcomer Investor podcast, and he asked me about the company because I had posted screenshots receiving a dividend from them, and then I said,
Another company that I think you still own at least, and it's also from Manitoba. That is Exchange Income Corporation. Tell us about this one. What is it? Why do you like it? What's your plan with it?
"This is going to be a very short one. I'll be very honest with you. I
Okay.
bought them because I we thought it'd be funny if we could go to their annual shareholders meeting.
Okay.
Me and my friend each bought one share just so we got invited to their shareholders meeting because it's in my city that I live in.
Mm-hmm.
I don't actually know what they do.
Oh,
And, as the fortune foretold, I went to one of their shareholder meetings and was actually super fascinated by the company. Did a lot more research there, and then now it's actually one of my largest stock positions. So that's funny how that works. But what is your kind of realm of knowledge and experience with this company?
This is one that I've known about for probably about a decade now. It was actually before I was really a dividend investor. I was more of like a value investor, and it was one that kept popping up on my screen as kind of it had a big dividend, and it was like a lot of the value guys liked it. I remember looking at it back then and just really not understanding what they exactly did, and so I sort of excuse me, put it aside for a few years, and then probably I'm gonna say 2 years ago, it kind of entered my radar again. It just like went up. I seem to remember going up to like $65 or $70. I might be wrong there. And then it just sort of like kind of went down as interest rates went up. So this has got to be 2023 is when this happened. And basically, this is a company that borrows a lot of money, and everybody thought that hey, if interest rates are going up, these guys borrow a lot of money. They're not going to be as profitable. So I took a look at the stock at that point, and I liked what I saw. I saw they had some interesting growth stuff happening in aviation. We'll talk about that more later. And basically, I looked at it, and I liked the premise, and I liked the valuation. I thought it was cheap. I liked the dividend. I liked the history of dividend growth. So I kind of put all that together, and I thought, hey, this is pretty interesting. I bought some, then I bought some a couple more times as it sort of hung around that $45 to $48 level. And it's done tremendously well since. I think it's what, 126 as we record this.
Yeah,
So
I'll bring
that's
it up.
been a fantastic investment for me. So that's kind of how I got involved in this one.
Yeah, like around that kind of interest rate dip 2023 area that you're talking about, that's when I would have entered in a major way as well. Yeah, 126.18 it closed today. I was up, I think I have shares at $40. And I was up like 100 and something percent, and now I'm only up 60% because I've been averaging up,
Right.
buying. Yeah, and then like really kind of a precipitous, like up 91% just this year. Almost doubling in value just this year, which is crazy and kind of came out of nowhere, where my kind of dividend portfolio was growing and growing, and I'm like off the back of a couple different stocks, and you can kind of see if the camera can pick it up, it's kind of a choppy. This is a 5-year chart, and then just basically a straight line up if you're listening on audio. And I tweeted the other day, I don't know if you saw it, but I circled a circle kind of down here. That's when the CEO bought like 40,000 shares right before it went basically straight up. So that was kind of my little like, remember to look at insider buying, because sometimes that's a good, gonna show what's
They
gonna
say
happen.
that a insider has a million reasons to sell, but only one reason to buy. And I agree. Actually, I probably should look at insider buying a little bit more often. I probably, have missed that sometimes. It's a good piece of advice.
Yeah, yeah. So I guess we'll kind of start at the beginning. This is a company that was founded in 2004 by two people who are still the CEO and chairman of the board, vice president sort of thing, and both very involved in the day-to-day of the business. When we recorded a podcast a few months ago when you were visiting my city, I was trying to bait you into saying that I was your favorite Winnipeg business person, and you actually said that Michael Pyle, CEO of Exchange Income Corp, was your favorite.
As much as I'm a Willows fan, of course, he's made me more money, unfortunately, than what you have. But, you're my second favorite. Does that count?
Bruce Flett, he's not. He's Winnipeg.
Ooh. Yeah. Okay. Well, I mean, stop saying names. You're just going to go down the list.
Mark Chipman, I know a lot of people around here are big fans of as well. He doesn't own any public companies though, so it's anyway. But so 2004, I'm going to ask you a question. Why go public in the first place?
I mean, because you need money. Like that's the sort of the answer to that. And back in 2004, I'm going to reveal my age a little bit here, but like, in the market, just in general, 9/11, the economy wasn't really doing that well. I'm from Alberta. Alberta was, because oil was doing well, but for the most part, like, the economy in general wasn't really doing that well. And venture capital, as we know it today, where it's like you have an idea and like some contacts, and next thing you know, you're raising millions and millions of dollars from these venture capital guys. It wasn't like that 20 years ago. There was relatively fewer options for guys like these guys, and especially they started out buying very unsexy manufacturing businesses. And it's hard to find people to get bankers or whatever in terms to get really, really excited about that and to keep it private without having a whole lot of money of your own. So, you're left with really one option, and that is to go public. And of course, what the detail I'm missing here is this is in the middle of the TSX income trust boom, where when Exchange Income first debuted on the TSX, it was an income trust, and it paid out. I don't remember what the yield was back then, but the tax setup was that essentially these companies didn't have to pay tax. It was passed on to the unit holders, who then had to pay tax on the distributions. And the distributions were passed through. All of the money essentially went to unit holders. And, like, they were very popular with retirees back then because they wanted the income. So that gave them kind of an attractive market to IPO into, even if, you look at the company and it's like, it's this growth by acquisition, rolling up manufacturing companies at that point in time anyway. And it's like, maybe that's not the right model for a roll up like that, is to pay out all of their, earnings out as distributions or dividends back then. You might want to keep some, reinvest it, but they were kind of hampered by the market, and so that's what they did.
So yeah, as far my understanding was, they were kind of doing this, buying companies and running them pre-going public, and then their big purchase that they wanted to make was this company called Perimeter Aviation, right? I think that was the first one.
I believe so, yeah.
It's either Perimeter or Calm, one of these airlines, and they wanted to spend something like $4 million on it or something. Like, now that they're a $3 billion market cap company, it's like seems small peanuts to raise. Like, I feel like you could have just gone and got a bank loan for that, but they wanted to buy this airline. And not an airline in a traditional sense. I guess we should probably dive into it relatively soon, but it's a serving northern communities, especially here in Manitoba. A lot of cargo planes and a lot of small passenger planes to remote regions. So it's not like an Air Canada. What are the big ones in the States? Like, it's, the Spirit Airlines that just went out of business. It's not an airline like that in the traditional sense. They're airlines in quotations, so they don't suffer from the same giant overhead like these. They don't have these giant jetliners and regulation and all that stuff that an airline would have. But they wanted to make this purchase, so that was how they decided to raise the money to begin with, instead of going another traditional route like a bank loan, or, like you were saying, venture capital, like keep it all private and get money from people. And one of the reason, like the word you said was unsexy manufacturing, which is one of the reasons why I'm very interested in this company, because that's kind of how I've been taking my career. Is I've made like 2 acquisitions over the last 3 years, both in the rubber stamp manufacturing and in custom engraving industry, which I think you could definitely describe as unsexy, but they are not to the scale of this company, but like printing money as far as I'm concerned. And it's making stuff that nobody, ever thinks about. So I very was interested in that. And then I'm continue to be interested in this kind of niche of these airlines and stuff that like no one really else is getting into and cares about. So that's where we started, was with Perimeter Air, and now they own 10 airlines. I'm kind of looking at their website in front of me here. And then a bunch of, like, they own a window manufacturing company. And then they've been getting into a lot of medevac, like helicopters that pick up injured or sick people or whatever, that like when someone stubs their toe in the mountain or whatever and they need to be evacuated, they send the helicopter. So they've been investing in those companies. And then, if I'm remembering correctly, I mean, I always mean to take notes and then I never do, but they have been investing in medevac companies in like the other East Coast there, and they have like government contracts that are pretty lucrative, let's say.
So I think that's the nice part about the medevac business, is we can talk about that, is you have a certain amount of cash flow certainty from the government. I mean, in Canada, we have socialized medicine. The government is ultimately the payer, which is a couple advantages, I think. Is one is that the government is going to pay its bills. You know that if you sign a contract with them, that they will honor it. And 2 is I think that there's this lack of competition in that industry, and because it does take a certain amount of expertise to get going, it takes a certain amount of capital to acquire the helicopters and the airplanes and these specialized equipment that's needed to go on these things, so that as you're flying, you can try to save somebody's life. So, you kind of combine those two things together, and it's like this is a pretty attractive business. It's got good returns on capital, and I'm not sure in Canada anyway if there's any other player in this field who is competing with them on any sort of large scale. My understanding is, and I might be wrong on this, but they have most provincial medevac contracts in the country, and they've expanded to. I think they signed one in. I want to say the Netherlands. I might be wrong, but they've started expanding it outside of Canada as well.
Yeah, as far as I know, like from reading and then also from going to their AGM, that's a very lucrative business and one that is like very secure. And then it's kind of in their realm of expertise because like I was just scrolling on their website. It looks like they have 19 subsidiary companies. More than half of that are small airlines. Each serving kind of different regions, northern Manitoba, northern Saskatchewan, northern Alberta, and then as well as the territories, obviously. So I actually work with a lot of these companies. I make office supplies for 5 or 6 of them, which is funny just scrolling through this list and seeing like all these names. And then I actually also use one of their services for getting stuff up north. We have a store in Nunavut that we supply with rubber stamps and whatnot for clients out there. So I wrap up a box like once a week and I give it to one of these companies and they put it on a pallet and fly it up. Or I don't even know if it's in a pallet. It might just be shoved on a in a plane or whatever and bring it up there. And I'm imagining they airdrop it with a parachute or whatever.
Yes.
But I can't imagine that's how they do it. But
with a giant bullseye painted on the ground.
Yeah, exactly. So it's kind of cool to see. But yeah, so a lot of these. If you're not familiar with the Canadian North, it might be kind of confusing, but these are like remote areas and a lot of the places don't even have roads that you can drive on. So getting there by plane is often one of your only options. And who's going to run planes? No, someone has to do it, right? So these little companies started popping up where they have like... some bigger planes, but also just like I've seen pictures, tiny little prop planes, like, 4-seat kind of things. And so that's very cool. And then that's kind of, they found their niche in that. Like they started with the first acquisition in 2004, and now they have, 10 plus different little airlines or whatever. So definitely a niche business. But as I like to talk about, in the context of why I'm such a big Northwest company investor, is that there's going to be a lot of imminent development of Canada's North over the next decade and longer. Eventually, maybe they'll highway the whole thing and it'll make all this obsolete. But for the time being, these companies, I think, are only going to get busier with the development of the North. So it's kind of a two-pronged thing with Exchange Income Corp itself, is that these companies, I think, have a long runway to keep growing, and then their core business is acquiring more of these companies, or not necessarily these companies, but more companies in general, so they can grow their revenue in 2 ways, which is adding parts and then also making sure the individual parts are operating at a higher growth rate.
Yeah, that's it. You talked about these are specialty businesses, a lot of these things that they're acquiring. In terms of, transport to the north, this is a very steady, you said there's growth in there, and you're absolutely right. There's a big investment coming from the Canadian government in terms of military stuff up north. They've kind of realized that we're vulnerable in the north, where we've underdeveloped there for, decades basically. And with climate change, if somebody wanted to come in through Canada's north and sort of invade us, we're pretty much hooped. And before, it wasn't a big deal because all that was frozen. Well, now it's opening up, and this investment needs to be made. So Northwest Company benefits from that, obviously, because they've got all the stores up in these remote communities. And then Exchange Income benefits because they have these cargo routes, passenger routes, etc. The beauty part about these businesses is that with WestJet or Air Canada, there's a certain amount of travel demand that is just created by a good economy. People want to travel, whatever. And the North, it's not really like that. Like, you don't go to Tuktoyaktuk unless you have to. There aren't many tourists going up there and saying, "Oh wow, like what a great place." I mean, like a lot of these places don't even have cars. Like, you drive around with a quad in the summer and a snowmobile in the winter. Like, these are very remote places and they need stuff. They need food, they need rubber stamps, they need all of the stuff that we need. But instead of shipping it up there with trucks, which is impossible, you have to fly it up. So these are just good, steady businesses. But ultimately, with the beauty of Exchange Income Fund, or Exchange Income Corporation, it used to be Exchange Income Fund. For me, what I like about it is you have all these businesses that they've collected. They're good businesses, but a lot of them don't have this growth potential. It's just this good, steady, whether it's manufacturing, whether it's, like shipping stuff up north, whatever. Then you take all this excess cash flow that these businesses provide, you pay a lot of it out in dividends, but then you have the rest. And what do you do with it? Well, you reinvest it and you put it into new businesses. And that's the beauty of something like this, is that, like, you can take the earnings from these businesses that you couldn't before. If you're just running a medevac company, really the only way you can expand is to, like, kind of expand your geography. But Exchange can take this income and they can put it into new manufacturing businesses, something, niche airline related, anything really they can do. So for me, that's attractive, that, these businesses that might not have much growth, you can take that money and you can put it to work doing something else.
Yeah, so I wanted to touch on this kind of idea. I don't think I coined this, but like permanent capital firm is the word I've been kind of using recently to describe businesses like this, and Berkshire Hathaway and Fairfax, and these companies that are similar but not similar to private equity. Because when you say private equity, the implication is that they're kind of, for better or for worse, they're kind of buying companies, fixing them up, and reselling them is kind of the idea. And a company like Exchange Income Corp, the idea is to not do that, is to, exactly what you said, take a profiting business, take some of the capital, pay it to the shareholders, and then take some of the capital and put it towards expanding, outwards rather than upwards, I guess. So do you like this idea of, permanent capital rather than like over private equity?
Oh, for sure. And I think that the Exchange has a couple of big advantages when it comes to doing it this way rather than private equity. One is that for most of their deals is that they give a combination of equity and cash when they acquire something. What that does is, and usually the management team of the company that's been acquired stays on and runs it. And it's basically just whatever your profits are, ship them back to Winnipeg, and we'll do what we please with them. So when you're looking to sell, you get kind of this equity participation in the company that bought you. So it's this kind of, you go from this long-term investment in your own company to this long-term investment in Exchange Income Fund. And two is that if you're the CEO of a rig matting business, which Exchange is in that business, and you own the shares, you're going to act like an owner versus somebody who just acts like a manager. A manager might be, hey, I'm going to give, big bonuses or whatever, because what do I care? It's not my money. Where if someone owns a small part of Exchange, then they're going to act like an owner and their interests will be aligned with my interest as shareholder.
So do you know off the top of your head, like how much they would do like equity versus cash when they're buying something?
Every deal is different. I know that. And okay, there's another company that's very somewhat similar to Exchange. It's called the Decisive Dividend Corp. It's the same thing. It's just smaller. Decisive, I know for sure. They say we're doing debt and equity in every deal. And with them, it's like they try to do 50-50. With Exchange, I'm not sure what the percentage is, but I am fairly certain that it's like there's some equity in every deal and that there's a certain amount of, like you agree not to sell for a certain amount of time. But I'm not exactly sure what the details are with deals. And in terms of that lockup, I don't know what that would be at all. But I think that that equity component is important. But I think that the sellers, I think they want that equity component. And I think that separates Exchange from private equity, because private equity is just, hey, like, well, private equity chances are going to pay cash and then just get out. Like, we'll put our own managers in.
Yeah, and I mean, like, there's also what private equity is in theory and then what private equity ends up doing. And what private equity in theory does is, I'm much better at running a small airline than you, so I'm going to put in my management and we're going to do a better job and we're going to increase net margins by 18%. And then the extra money now makes the business worth a higher multiple and we're going to resell it and wash our hands of it. And then what ends up happening is they buy the company, put in their managers that don't know anything about it, saddle the company with debt, sell it for pieces, and then it goes bankrupt within 5 years, and
maybe fire a bunch of people in the process.
yeah, giant layoffs, and yeah. So,
which if you're the owner, you don't want, right? Like,
yeah,
you know these people, and if you're a small manufacturing company with 100 or 200 employees, like, you're going to know everybody.
Yeah, and so that's why like the permanent capital firm model always appealed more to me than like. I kind of did the metaphor of two different ways to do like real estate. You can buy and flip homes, or you can like buy and rent a home, right? And the longer term equity would be in the rental part, because then you get the monthly income, and then you also build equity, and the value of the home grows, rather than just getting a $25,000 profit right now and then washing your hands of it, right? So I always liked the idea of buying a company and then just holding on to it forever is kind of a cool idea. And when you're kind of like newer to these sorts of companies, really like Berkshire Hathaway is kind of your first experience with it, but they're so massive that they're so much more hands off, I think, than like someone like an Exchange Income Corp would be, because like I've only been really paying attention to kind of the stock market for the last 6 years, sort of thing. So I'm not going to be like, well, back in the day, but I'm just like taking like Berkshire's position in like Occidental Petroleum. I remember they were kind of like freaking out that he bought so much, because they were thinking, maybe are we getting a hostile takeover or whatever, and then he had to be like, no, just keep doing what you're doing, I don't want to be involved at all, like I just think you're a good company, sort of thing, which is like different than like the takeover of like a Dairy Queen, for instance, which was like more involved, and like eventually he's like, I want to work up to owning 100% of it or whatever. So I like the kind of, well, I guess like that's a question, is like, does Exchange Income ever buy less than 100% of the company?
No, I've never heard them do that. I think control is important to them, but not necessarily on a day-to-day basis. Like, they very much leave the old managers in and just like, hey, do your thing, but just send the money to Winnipeg. And that's what they're after. And so, of course, if you own, 40% of a company, and then it's like, well, you can influence how much money gets sent back to Winnipeg, but until you own 100% of it, you don't really control how much money gets sent back to Winnipeg.
Yeah. And I think that's more reliable, just to have it kind of like all in your control. And then I guess it's like, something that I think would be very difficult, because like right now I own three companies and I kind of move the money to which company needs it the most at the time. Like if business number three needs to buy a piece of equipment, then, most of the profits from all three kind of go that way for 3 months. So we can kind of, whatever. But it must be hard with like 19 subsidiaries to kind of steer the money where it needs to go and whatnot. So I don't envy that kind of those people that have to make those decisions. But I imagine there's times where one of the businesses is struggling and needs kind of more financial support and also managerial support than the other companies. And I'm curious how they like balance that. Um, you don't want to take away too much from one company to, yeah, I don't know. I'm kind of
Well,
just
one thing
musing
I
on that.
was one thing I was reading with Exchange Income lately is that they've been working on getting their debt rating up to investment grade. So rather than before, they were using convertible debentures on the TSX to fund a lot of their acquisitions. And those come, nowadays at like kind of a 5.5 to 6% interest rate, which isn't bad. It's like, their target has always been 15% return on capital. So if you're paying 6% on the debt and you're getting 15% return on capital, there's some wiggle room there. So that's good. But now they've actually been able to secure a investment grade, their triple B, which is not great, but it's good enough that they can borrow at kind of like 4.5% rather than 5.5%. So they're in the process of taking a lot of these debentures and some of this bank debt and stuff and getting it down to these lower interest rates, which is going to help them. But the point I'm going to make with this is that when you have this big company as your head, they have the ability to borrow. And so if you need capital, if you want to expand a plant, you want to do whatever, you can go to Winnipeg and you can say, hey, like we want to spend not just this year's profits, but more than this year's profits on whatever. Can we do it? And they can say, sure, no problem. We could just borrow the money. And as long as the projected return exceeds that 15%, I think Winnipeg would be happy to do that.
Yeah, and that's interesting. Like this is kind of opening my eyes to a different perspective because as like I'm heavily involved in all three of my subsidiaries to the point where I'm basically acting as the CEO of all three companies. And it's almost not a foreign concept, but it's an interesting concept that the business would operate like completely independently, and then they would come to the decision that they need to make a big capital expenditure, and then they would like present the parent company with like, here's what we need. So I think that's super interesting way to kind of do it. And I guess like the whole idea of buying good companies is you want to just let them be good companies. You want to just leave the management and let them, have the tools to continue being a good company, right?
Yeah, and of course that's for me the beauty of the stock market is that I don't have to, like you have these decisions to make as the, de facto CEO of all three companies where it's like, hey, like what do I do here? What do I do here? And it sounds like what you're saying is that you want to get to the point where it's like these are all independent kind of organizations and you're sort of the guy at the top. We talked about this, I think, in the last pod we did, where it's like, how much time do you spend on big picture stuff, on acquiring new businesses, on capital allocation, whatever, versus sort of the day to day, hey, what do I do? This machine broke, kind of thing. And so anyway, for me, like that's why I love the stock market because it's like I just outsource that to smart guys who are in charge of these companies and just kind of trust them to do a good job. And if they don't, I can sell my shares if I want to. Now, I try not to because I really try to take a long-term approach. I think that, investing and owning a business are basically the same thing. I'm not a flipper of businesses. I'm not a trader. I'm an investor. And I want to reap those long-term gains.
Yeah, me as well. And I think that's kind of what we talked about with the metaphor of the house flipping and also with the private equity. It's all kind of the same idea where there's different ways to make money, but permanent capital versus private equity is the same kind of thing of like investing versus trading for the most part, right? I wanted to ask about the stock price going up 100% in a year, 200% in 5 years or more. It's hard to make an investment after a run up like this, or am I unique in feeling that?
Oh no. I well, it was this pod's actually a nice bit of timing because I hadn't really looked at the company and call it the last year like as this run up. I just sort of just hey wow, it just keeps going up and up and up, and I knew that they were expanding big into the Medivac part of it, and I knew that like these were generating earnings. So I actually took a look to see just how much extra earnings, like you said, the stock has doubled. So I look at the results. I'm looking here. Free cash flow is up 50% year over year. Not quite 50%, but pretty close to 50% year over year. And so the stock has doubled, free cash flow is up 50%. So it's like there's a disconnect there. But at the same time, it's like it's not like this thing is just going up on spec, is going up because people are, excited about it, whatever. Like there's growth in earnings, there's growth in free cash flow. And even after the run up, the valuation is quite reasonable. It only trades at like 12 times, 13 times next year's projected free cash flow. The analysts might be wrong on that, but it's really not super expensive even after the run up.
So you think like with that analysis, you think it was cheaper, like you think it was cheap, undervalued before?
Yeah, exactly. Like I remember paying, I think it was between 7 and 8 times free cash flow, which I thought was a steal for a business that, assuming that it could continue to, expand and acquire and everything. So I think maybe 12 to 13 times free cash flow is probably more fairly valued, but I don't think it's overvalued. I think that these are the kinds of businesses that sometimes investors will get really excited about it and they'll say, hey, like I see all sorts of acquisition potential for these guys in the next few years. So I'm just going to bid the stock up now and in the anticipation that that's going to happen. And you might get to like 20 or 25 times free cash flow. I think that would be expensive. But where we're at today, I don't think it's particularly expensive. I also don't think it's like super cheap. It's just fairly valued, which for me is good enough to keep holding.
Yeah. And so speaking from a little bit of experience, obviously with smaller companies, but I'm trying to take kind of different ways of valuing companies like this that aren't just multiples of free cash flow, because I know that like when I did acquisitions and then I needed to modernize those companies with equipment purchases and whatnot, my EBITDA is going almost to zero for a period of time because you need to do those capital investments to kind of get things rolling, right? So just the amount of profit that you're making isn't necessarily a good like way to value a company like this.
Yeah, no, you're onto something. And I will mention that in 2024, 2025, these guys struggled with free cash flow because they were acquiring so many planes to, planes and helicopters and whatever for these Medivac businesses. And so, you do have a little bit of like these numbers are going up against weaker numbers last year, but I think these guys are good at kind of stripping out that growth capex and just kind of saying like, hey, like, yeah, we know that we have to acquire planes, but we're going to kind of ignore that because we know that that's growth capital expenditures versus maintenance capital expenditures. If you look at their quarterly results, they always separate those two out so you can kind of see the difference with those two numbers.
Yeah, and I think that's a smart way to do it. It might not cut through the noise of the average stock market investor, let's say, that just sees line go down on profits, so therefore bad business. And that may have resulted to why the company was in the position where it was undervalued, was because people kind of don't get the context behind the numbers that they're looking at. Like, because for instance, when I did this most recent acquisition I did in, about a year and a half ago, there was almost no profit to speak of on the books, at least. But using context, I could kind of see where the money was going. And now, year one, we're able to squeeze out an extra $80,000 of profit on 500 grand of sales in the first year, just based on, cutting stuff that I could, like, expenses that weren't actually expenses if I was going to take over, et cetera, et cetera. So there's this, what I'm trying to say is, like, diving deeper than just we have less profit this year with context, really kind of helps you out. But that leads me into kind of my next question, which is a lot of people, let's say on financial Twitter, don't really look that deep into stuff. And then you also get a lot of people on financial Twitter that have been very critical of this company for a lot of different reasons.
I believe we know a certain someone who kept calling it a Ponzi scheme.
A Ponzi scheme is yes, yeah, that's kind of what I was getting to. That is insane to me to even make that assert. But they weren't being facetious. They were 100% making that assertion that it was a.
I hope this person is listening, because if he is, suck it. You were wrong.
Yeah, I mean, like, it's not, right? They own companies, like, it exists. Like, it wasn't a Ponzi scheme. But there has been people that have been critical of a lot of things. I want to go through kind of some of them. A big one is the kind of dividend, growing the dividend for the sake of growing the dividend, let's say. That's been kind of what they've been accused of before.
Well, I mean, look, everybody thinks that they know better than management. It's a common affliction on not just FinTwit, but I'm going to say the financial world in general. There are so many investors out there who just cannot outsource management of their companies to management. I know people who will email investor relations to, like, I don't agree with, I'm doing my angry, keyboard thing, because it's like, you're emailing investor relations to say, I don't agree with some decision. And, like, I'm sorry, but, like, what fucking cringe behavior. Can I swear on this? I just did.
Yeah, whatever.
Like, just cringe as hell. Like, if I was the CEO, I would, like, find this guy's house and knock on his door and, I don't know, like, give him the finger or something. Just, like, what cringe behavior. I think it's so stupid. But look, in general, I think that another rant coming on here, in the age of AI and the age of, I know so many times, so if the people who don't, like, know me or follow me or whatever, I share a lot of, like, kind of stock ideas on Twitter. I see something that's interesting, I'll share it. And that doesn't necessarily mean I own it. That doesn't necessarily mean, like, I'm super bullish on it or whatever. It's just, I'll look at a company and I'll say, that's interesting. Let's, like, kind of throw it out there and sort of see what people think, or, people appreciate that. And for me, it's like this, okay, look at this, get interested like I did, and then go start your research. And what I'm finding is that people they'll DM me, they'll, like, whatever, and they'll say, hey, thanks for the tip on whatever. I bought some based on your tweet. And I want to, like, reach through the screen and strangle these people, because don't buy stuff you see based on a tweet, and don't, like, use the AI summary of the earnings report and then buy a stock. Like, read that yourself. It's this responsibility to your money to do the research. And often what I see, and the perfect example what you're bringing up with the, Buddy and calling it a Ponzi scheme, is that guy clearly didn't do the research. He looked at, like, some aggregate site which just looked at the numbers without any context at all and said it's a Ponzi scheme. And to have that sort of conclusion based on that little amount of research, which was shitty to begin with, just boggles my mind. Anyway, rant over. What was the question? I don't even know.
Well, first I'll interject in saying I bought 100 shares of Peso Rama, which is the Mexican Dollarama, just because you tweeted it, and I thought the ticker was Peso, and I thought that was funny. And we're doing very well on that.
Good, good. I love how they called themselves Peso Rama, even though they have no affiliation with Dollarama.
Yeah, it's the
Like,
same name,
perfect
right?
riff.
Peso just means dollar in Spanish. Like it's the same name exactly.
By the way, Dollar City, which is Dollarama's Latin American brand, is expanding into Mexico, and I think Peso Rama gets killed.
Okay, I should sell at the top. I'm up like pretty high after being really down, but it's also like
Admittedly,
100 shares.
I
is
have
like
not
20
done the
bucks,
work.
I'm pretty sure.
Yeah, I have not done the work on Pesorama, so I might be wrong on that. After I was just railing about not, doing any research, I should probably be very clear that Pesorama might be this diamond in the rough. I know Dollarama, and I would not want to go against Dollarama.
My question was regarding criticism of the dividend specifically.
Oh, yes, yes. So there's a kind of a similar company. It's called TerraVest, and they have a very, very small dividend. They've grown it a little bit, but their yield is maybe you can look it up while I'm talking here. It's like I think it's under 1%. It's TVK is the ticker, and their strategy is they take the cash flow that these acquisitions have, and they use it towards.
69.
Oh, nice,
Nice.
nice. So that's their strategies. They take the cash flow and they put it towards the debt. They put it towards the next acquisition, and then that way they grow faster and yada 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 yada. Which, okay, that works. I'm not begrudging that at all. But Exchange Income Corporation, one, the word income is in their name. Two, they came to be as an income trust, so their history is that of a company that pays dividends. And three is I think that it attracts a larger investor base in Canada because there are a lot of retirees and a lot of people like me who appreciate dividends. So you kind of put all that together, and I can see why they do it. At the same time, I can also see the logic of TerraVest and retaining most of that cash flow. So basically, they both work. It's just you kind of have a choice of which one you want based on kind of what your preference is. I know some people just hate getting dividends, and some people I think that it's just kind of they criticize people like me for insisting on a dividend. They say it's illogical, and I think that their hatred of dividends is illogical. Like, you think someone would be dividend agnostic, but they're not. They're like the dividend atheists. If I'm like the dividend religion, then they're the dividend atheists. Like they're kind of obnoxious in the same way I'm obnoxious. Not that I'm calling myself obnoxious, but
Yeah,
basically it's like the dividend has advantages, it has disadvantages, and that might depend on your personal situation or your personal kind of outlook and opinion on dividends in general.
Yeah, I've been very publicly on the dividend side of the dividend versus growth debate, mainly because I don't like the whole 4% rule where it's like, you retire, you withdraw 4% of your portfolio, and that should, in theory, last long enough until you pass away, and then whatever, right? But I prefer the dividend idea for a individual because I don't like the idea of selling assets. It doesn't compute with and then maybe that comes from my small business background where I'm starting businesses. It's like, should I sell off 5% of my startup to pay my mortgage? That doesn't make sense to me. I should generate income with the business and then pay myself part of that income, which is literally a dividend, right? So that's always the side I've been on the debate. But it complicates it for me when I start talking okay, let's zoom out. Now let's talk not for the person, but let's talk for the company itself. As the CEO or whoever's making this decision, would more cash to make more acquisitions be more beneficial for the company to grow faster than paying out whatever it is in distributions to people? And that's a more interesting and more nuanced debate that I don't have a clear answer on. Because famously, like, Berkshire Hathaway pays no dividend. Have they ever done a special windfall dividend? I'm not even sure.
Way back when Buffett first took over, I'm going to say like the late 60s, he paid a one-time dividend and disliked it so much that he never did it again.
Yeah, so famously, and we can both agree he's the GOAT, if not, like, he just is. And so that's fine. That's a strategy. But then, yeah, I don't have an answer, and I don't think I can work it out in this kind of the short time that we have. But I think that's definitely something that complicates it for me, is that if I had these handcuffs where I had to pay out a certain amount of my company's money, that would severely limit my ability to make some more aggressive kind of acquisitions and moves that I might need to make the business. And I think that's been the general argument for like why these giant tech companies shouldn't pay a dividend either, is that they should be investing in R&D and growing. And then their cash pile hits $100 billion, and then they all have to decide to start paying out. When NVIDIA starts paying a dividend recently, we know that we've kind of hit peak here where they have too much cash on hand.
So my view is that a dividend creates a certain amount of discipline. If you have every nickel of cash flow that the company produces that you can put to work in new investments in the company, there aren't a lot of companies on the planet that can invest all of their income intelligently every year without fail. They're going to have some duds in there because it's just the way that it works. If you're paying out, say, half of your free cash flow to dividends and you're using half of it to grow the company, well, you have to be a lot more selective at that point because you just don't have the capital available to go buying stuff willy-nilly. And I think that deals are sexy and they're fun, and management teams want to do that because the company gets bigger and everybody thinks that they're great, and they have the potential to retire as this like legend in business. So from that perspective, like, I can see how bad deals might get done there. And the other thing is that I don't believe that, like, there's Warren Buffett and there's these guys who are just fantastic at capital allocation. Well, one, Buffett's had some duds in his time as well. Nobody's perfect. And if Buffett's had some duds, then if you have like a mediocre manager, he's going to have more duds. Yeah, she's going to have more duds.
I'll let you know right now, listener, you're not Warren Buffett.
No,
so
you're not.
Maybe don't structure your company. You know what I mean? Like, it's, yeah, but neither am I. So that's fine. That's an interesting perspective. I think that you almost keeps you more accountable, that you can't just punt all the company's money and go too big. And it's also like, I've also heard the argument from people that it's like, why even own a company if you're not getting money from it? You know what I mean? Like, why just growth for the sake of growth? Like, dividends are kind of, why am I owning this company? Is to make money. And that's a way you can make money, from the company.
I read something once where the author called non-dividend paying companies baseball cards. And you're just trading baseball cards with other people, hoping that the value of your baseball card goes up. And I don't believe it because, like, I know that companies trade on multiples of earnings. And sometimes the multiples get big as people are excited. And sometimes the multiples are smaller as people are bearish. But trade on multiples of earnings for the most part. There's some pretty rampant speculation in certain parts of the market right now, but the baseball card analogy I think is a good one in terms of the fact that we have to remember when we're buying stocks, we're buying businesses. You talked about the kind of that mindset of owning a business. And for me, it's like, people talk about how dividends are like what forced cashable or taxable events. And if you just like kept the money inside the company would still be worth the same. So why not just sell? And like, they're the same thing. And my view of it is it's like, that's just galaxy brain fucking nonsense. You look at it and it's like, a company earns profits. You as the owner get a portion of those profits. Like, that's business 101.
Yeah. It
And
makes sense to me.
it's the other side of it that's like made it more complicated and has turned it into something that it's not. And that's fine because it's like that's their view on dividends. But my view is that if I own a company, I expect them to pay me back a portion of the profits. And that portion might be smaller if it's like a growth company, or it might be bigger if it's a mature non-growth company. And in terms of like dividends or share buybacks, I'm happy to get both. But I want dividends. If only companies doing share buybacks, I'm not interested in owning it.
Yeah, I think that's a fair perspective to have, and I think it's very similar to mine as well. I think I want to we'll go from here on to like dividend growth specifically, because keeping the dividend the exact same in relative terms is one thing, but then the decision to grow that percentage, because if we have this amount of free cash flow or profit and we decide, okay, half of it gets paid back out as a dividend, when do we decide when 51% now or 52% now? And something that Michael Pyle, CEO, said when I attended the most recent general meeting was, and I don't know, I don't think he was probably throwing shade at a company, but I will. A company like Realty Income, what are they called? Realty O, ticker O.
Yeah.
Where they pride themselves in all their marketing, all their investor marketing. We increase our dividend every quarter, no matter what, or every month, no matter what. We've done 186 consecutive increases. And then look at how the stock's been performing. But, that's a different topic for another day. But something that Michael Pyle said was we don't increase our dividend just to increase it. We increase it when it makes sense to increase it. So I just want to kind of dig into what does cause it to make sense to increase it.
Yeah, I think that there's a lot of investors who put a lot of weight in consecutive dividend increase streaks. Fortis here in Canada, I think they've had 51 or 52 years of consecutive dividend increases, and people love that. It's like, yes, like what a streak. And I think that there's a little bit too much emphasis on the streak itself and maybe not enough kind of like over time. I do want to see an increase in dividend because one, that tells me that generally for the most part, earnings are increasing. And if earnings are increasing, then the dividend can increase alongside of it. And the percentage of earnings paid out kind of remains the same. So, like I think that is one of the basis of a healthy company. Secondly, an increase in dividend for, folks who are retiring on dividends. It's a really nice inflation hedge kind of built immediately into the stock where it's like, hey, you can be fairly certain that Fortis is going to increase their dividend by about kind of 4 to 6%, call it 5% a year. Inflation will probably be kind of at like 2 to 3% in someone's retirement. Therefore, your retirement income is going up faster than inflation, meaning that you can spend more if you choose. So that's really helpful from kind of that perspective. But like I said, in general, it's just more of I want to self-select to companies that are growing. I think that growth is important. And by looking at companies with a history of growing their dividends, as long as earnings cooperate, then that's ultimately what I'm looking for. I want earnings to go up over time because that'll increase dividends, but that also is going to be reflected in the share price as well. So that's ultimately what I'm looking for. Dividend growth is just a shortcut to achieving that.
That makes sense to me. This might be getting a little bit too in the weeds for some people, but I just want to be clear. When we're talking about a dividend increase, we're not necessarily talking about the percentage of the yield, because if the profit has gone up significantly, the dividend as a percentage of your profit may have gone down significantly. So an increase nominally, like in a dollar amount, going from 15 cents a share to 20 cents a share, is a 5% hike or whatever, but not necessarily hiking the percentage of profit paid out.
Yeah, exactly.
Okay.
So typically what a lot of companies will do is, like, we talked about they pay out, as an example, company might pay out half of their earnings in dividends. So they're going to maintain that percentage, that half of their earnings get paid out as dividends. But as the earnings increase, the percentage stays the same, so the dividend kind of increases along with the earnings. The other thing to keep in mind is that when you talk about dividend yield, so that is the representation of a stock's dividend as a percentage of the share price. So you buy a stock with a $100 stock that pays a $4 a year dividend. That's a 4% yield on your money. If that stock goes from 100 to 200, but the dividend stays the same, the dividend yield is dropped to 2%. So anyone who buys after that is getting a much lower initial yield on their money, even though the dividend would increase the same amount for both shareholders.
Yeah, that's definitely starting to get too in the weeds for my little pea brain. But it is something I'm trying to get better at, these kind of metrics, because like as a beginning investor, I'm looking at PE ratio and dividend yield, and that's it. And if those are both, in the range of what I'm comfortable with, then there we go. But now I'm really trying to do kind of more research into exactly how these sorts of companies function and decide that, because it's not like they're putting out a press release that's like, we're paying out a 5% dividend yield now on our share price. Like, that's not how it works, right? That's just your Robinhood app telling you what the percentage is based on, the share price or whatever.
It's a very common mistake when people first start out to just kind of chase dividend yields. I'll admit it, I did it.
Yeah, me too. Me too.
Yeah, like it's common. So if you're doing it, like don't feel bad. We all kind of go through it. Just kind of, keep in mind that the dividend growth and that stability of that dividend is much more important than the dividend yield that you're going to get there. Also, I'll kind of go a little bit back into the weeds here a little bit. There's something called the dividend yield theory. And this is popularized by a lady. Her name is Geraldine Weiss. She actually is a fascinating woman in I'm going to say like 1960s, 1970s. She decided she was going to go work on Wall Street, and nobody really wanted to have her unless she was going to be a secretary. She obviously didn't want that, so she starts up a newsletter. And the kind of the thing that separated this newsletter was it relied on this thing called the dividend yield theory. So basically, rather than looking at a stock's dividend yield and comparing it to other stocks, so you might say, oh, wow, like a 5% dividend yield, it's pretty good, but this stock over here pays 7%, whatever. What you want to do is compare it to that company's dividend yield in the past. And what she found is that generally a company with a larger than normal dividend yield was undervalued, and a company with a smaller than normal dividend yield was overvalued. So her newsletter basically over and over and over again would buy shares of companies when they were paying higher than average dividend yields, and would sell them when they were paying lower than average dividend yields. And it worked to the tune of about 13% per year, which beat the S&P 500 comfortably. So there is some logic in looking at a company's past and their dividend yield in the past rather than comparing it to other companies. Now, saying that, there's lots of instances where a company went from, paying a 2% dividend yield to paying a 5% dividend yield and then paying a 10% dividend yield and then cutting the dividend because there's some problem with the underlying business. But it does have some merit, I think, and I have added it as part of my research process. I do look at kind of where that yield is versus the history of the yield.
It's funny because that's almost counterintuitive. It's, the meme that's like when you have low IQ and then the middle IQ and then the high IQ, and the high IQ and the low IQ think the same thing. We could make one that's like, I should chase high dividend yields on both sides. Because the chasing the high dividend yield thing was kind of like what this whole yield max fiasco in the last, like, whatever that was last summer, where people are, there's these stocks with 40% dividend yields because they're selling leveraged covered calls or whatever the hell those were doing. So in that perspective, it was almost like high dividend yield, like anything over 5% was almost like a kind of a scary, like there is something wrong with the underlying business, right? So it's an interesting to turn that concept on its head, Lair.
Yeah, I'll just say that, like, in terms of a yield, like, I would say anything sort of above kind of like, call it 6 to 7%, you definitely want to ask some questions, especially today when a lot of the high dividend stocks in the TSX kind of went from, offering like 6-7% yields to, kind of like 5% yields now. But the big comparison is that you're looking at that company like versus itself rather than just chasing the kind of finding the biggest yield you can. And in terms of those yield max and whatever, it's like those aren't dividend stocks. They are these complicated vehicles, let's call them, that use debt and leverage, and they use covered calls, and they do all this kind of goofy stuff to create distribution income, which is then taxed at your highest rate, and it's all very complicated. And I would never touch those things, but like, that's an unpopular opinion that I have. I'll probably get some hate messages for that. So
yeah,
look, I'll just say that if you do own them, know what you own, understand what's going on behind the scenes,
because they're not companies. Like, they don't manufacture anything, they don't sell anything, you know what I mean? Like, so
they're financial engineering instruments.
Exactly. So before we move on, I wanted to just retouch on kind of the realty income sort of thing where they grow their dividend no matter what. Because we were kind of saying, like, keep it as a, like, for this example, 50% payout rate, but then as your profit grows, you can increase the dividend because to keep that 50% profit rate. But then what happens in periods where your profit is decreasing? Like,
and you have a tough decision to make, right? Like, and like that for me is why I like, kind of a payout ratio of 50% or even like lower, is that when a company does have a bad year and profits dip, they can still easily afford the dividend. The payout ratio might go from like, 50% to like 75%, but they're still fine and they can still afford that. It's just this kind of momentary blip in the business, and hopefully it recovers. In terms of like realty income, like at this point, it's just marketing.
Yeah.
At the end of the day, there's no difference between a company that, if realty income hikes its dividend by like, it's like 0.5%, sometimes 0.25% that they're hiking the dividend. Like it's stupid.
Yeah.
Like just hike it once a year, hike it like 3 to 4%, and like just do it that way, or don't. Like, if you've hiked the dividend for 49 of the last 50 years, I don't know. I'm not going to begrudge a company for that, especially if like the economy's bad or the company is struggling for whatever reason, or like with realty income, if interest rates are higher than what they were before. Well, that's a problem for a company that buys real estate. So, like, I understand all that. And like I said earlier, there's maybe a little bit too much emphasis put on those streaks. And I personally, as long as the trend is there, I don't need to see a streak.
Yeah, I agree with that. I just brought it up here. This is generative AI, so there's your disclaimer about these numbers. But for Exchange Income Corp, we're looking at trailing 12 months, approximately 76 to 83% payout ratio, with the 10-year median being 85%.
That actually sounds about right. I have their most recent quarter pulled up here. Their payout ratio for the last 12 months as of March 31st was 67% on adjusted net earnings and 57% on free cash flow less maintenance capex payout ratio. So currently right now it's a little bit below what it kind of has been in kind of historically, which would suggest to me that maybe the dividend would be increased sooner rather than later.
Yeah, that's kind of where I was going as well with that. Do you think that like why, where, how, when does a company, where are we picking 85% or 67% or 50%? Like what is that kind of going in your head, where that decision is?
That is a very good question. And I think a multitude of factors goes into it in terms of like reinvestment opportunities, kind of, how like with Exchange, they issue shares for a lot of their acquisitions. And so that has to factor into it as well, where it's like if you're paying for an acquisition with say like 40% equity and 60% debt, you've created kind of two sort of debt in terms of like things you have to repay at that point, because it's like, hey, you've created these shares out of thin air, you owe a dividend to these shares, and then with debt, of course, you owe the interest payment on the debt, and eventually you want to pay off some of that debt. So each company is going to be unique there, and it's going to come down to kind of all sorts of factors, and I think that's why you have to kind of look at it at a company by company basis. In terms of Exchange, I can see the logic of maybe slowing dividend increases, maybe having one like every couple of years, keeping that payout ratio a little bit lower so you have a little bit more money to either pay down debt or look for the next acquisition.
Yeah. So I thought it was interesting, kind of just sparked my mind there where you were saying, we create shares out of thin air. Would that be like creating shares to do an part equity buyout of a company? Would there be an argument there that that's bad for current shareholders?
You're diluting current shareholders if you create shares to pay for an acquisition. But the value of the company should increase by as much or more potentially with this acquisition. So Exchange buys a $100 million company, 60 million of it is debt, 40 million of it is equity, so they don't put any cash towards the deal. If the company is worth, say 50 million and they've overpaid, then that is obviously a bad acquisition, but it's very bad for equity holders because essentially like equity holders get nothing in this. The value is all going to be, paid back to the bank. But if the acquisition is worth 150 million and they pay 100 million, the equity holders get all of that upside. So as long as they're good at making acquisitions and they're making good deals, we shouldn't mind as equity holders that they're doing so. And just in general, I know investors, they look at something like that and they say, I hate dilution, I hate share-based compensation because that is all, like dilution at the end of the day. But if the dilution is creating more value than what it costs, then we should not mind as investors that much. The other thing with that is that everybody kind of has an opinion on the what equity should be worth. You know, you do it like a discounted cash flow model, which I don't, because I it's like there's the perfect example of like, you know, just nonsense and you can create like whatever the hell you want as long as you just like massage the numbers a little bit. So some people might say that like the cost of equity is like 20% a year. Other people might say the cost of equity is 8% a year or 5% or whatever. And it's like, you know, once in an interview, they, I think during the Berkshire Hathaway annual meeting, Buffett and Munger were talking about this, and Munger said something to the effect of like, Warren, do you have any idea what the you know, like cost of capital is in terms of equity? And he's like, no, like you can just pull any number out of your ass and try to make it make sense. So the point is that I think if you have a management team that has a good history of making these deals, just let them go with it and trust them.
Yeah, there's a little bit of faith in this kind of business, in like your leadership, more than maybe other business opportunities. Like, of course, you always want to invest in a company when you trust the CEO and the whole management team. But this is almost like it might be easier for Tim Apple to keep selling iPhones than it would be for Michael Pyle to decide on a new acquisition. Like, it's maybe apples and potatoes, but it's like there's almost more faith you have to have in this kind of leadership team for a company that's formed like this.
Buffett talked about the ham sandwich running a company, because you want a company that can be ran by a ham sandwich, because eventually you'll get a CEO that's that stupid in it. And one of my stock I've been buying lately is called Coca-Cola FEMSA. It is the Coca-Cola bottler in the southern half of Mexico, big part of Central America, and then parts of South America as well. And one of the things I love about Coca-Cola FEMSA is like, and this is no disrespect to the CEO if he is listening, but like a ham sandwich could run that business. Like, it's just what capital allocation decisions do you have? It's like, do we expand our distribution network? Do we expand our warehouse network? Do we expand our production? That's all you have. And then after that, it's like you have a bunch of cash left over. Then what do? Well, you either buy back shares, you pay dividends, or you pay down debt. And like, those are the kinds of businesses I like, because it's like, you know, Exchange, there's lots of businesses out there they could acquire, and that requires a certain amount of brains. Coca-Cola, like, just don't fuck it up, boys.
Yeah. Would you say, though, that like the acquisitions themselves would be more ham sandwichy? Like, do you think that's something that Pyle's looking for in a company to acquire?
I think the benefits to their approach of kind of like these niche businesses, and of course they have this framework in place.
Yeah.
I think it's on their website where it's like, hey, we're looking for, you know, like, this is our hurdle rate. These are the kinds of businesses we want. And they know that these smaller businesses in the private market, that the valuations aren't very high on those, so they should be able to meet these hurdle rates. So I think that, like, in terms of difficulty in acquisitions, Exchange Income is probably like kind of playing in a, you know, kind of like the shallow end of the pool a little bit. Like, it's a little bit easier than, you know, say if you're like Berkshire Hathaway. And although Berkshire Hathaway is a little different because they're so big now that their universe is quite limited as well. You know, so I think in terms of like just limiting your universe like that, that probably helps make things easier, I'd say, for sure. But overall, I would say that like a growth by acquisition company like that, you need more skill in the CEO chair than you would for like a Coca-Cola FEMSA.
Yeah, yeah, and I think I like the idea of kind of buying private market companies and bringing them, in, not that you're bringing them public, but you're kind of bringing them into your publicly traded company. Because like the two acquisitions I've made in real life, and we're talking about, sub $250,000 acquisitions, I'm buying at a valuation of like 1x cash flow. Like, so it's interesting to like buy a company for like 1 year's profit basically, and then you're trading at a valuation of like 12 times profit. It's like almost just the simple act of identifying that, grabbing a profitable company and pulling it into your kind of conglomerate raises the value of that company by 12 times just by doing that, in theory. Like, obviously that's kind of simplifying it, but it's an interesting just business model in general, rather than Berkshire. Like, I mean, we keep saying Berkshire Hathaway, but I think it's like it's the example of a company like this that is easy to relate to people. But a lot of times they're not buying, at least nowadays, off-market companies, right? They're just buying publicly traded shares on the open market until they've own a certain percentage of the company, right? So, if I had a conversation with Michael Pyle, one of the questions I would love to ask is like, how do you even find these companies? Like, where are you networking? What bars do you go to that you're talking to these people that you can even identify that these would be possibly for sale? Especially the super niche stuff, because I want to buy some. Like, where do I go?
I think that they have a unique advantage there for a couple of reasons. One is that you're this niche kind of manufacturer. There are not that many buyers for you, and there are especially not very many buyers who aren't private equity. So immediately, I think that universe gets pretty small. And then in terms of like we talked about earlier, this ability to offer equity in this new kind of this organization that you've become a part of, you're immediately like a part owner of this company. I think that's attractive, and I think that there's probably a fairly steady sort of like stream of phone calls into Winnipeg, just kind of saying like, "Hey, like, are you interested?" And they kind of sit down and they look and maybe not yet, or I think sometimes too it's like a multi-year process where somebody might say like, "Hey, like, are you interested?" and they sort of like kind of feel each other out for a little while, and then maybe the timing's not right or whatever. So just having the reputation for being in this business is, I think, a good one. I'll tell like kind of the story of my dad. He's getting out of this business now, but he was kind of in this, sort of lender of last resort business. And what he found was that he had to do very little advertising once he was sort of established in the community, because it was this word of mouth and just sort of this, hey, like, the bank said no, go talk to this guy, like he'll do it for you. So like, as long as it's niche and like you've got that kind of word of mouth behind you, I think that helps as well.
Well, I'll try to get that word of mouth behind me so I can start buying more rubber stamp manufacturers. I had a question about like when I'm Exchange Income Corp and I'm buying a company with 50% shares of my company. Who's getting those shares? Like, is it the corporation that you're buying, or like the ownership team, like the founder?
The ownership.
Yeah.
The ownership team. So okay. Often what happens in these kind of smaller businesses is that some of like the top managers get offered stakes in the business and they buy in or whatever after a certain amount of time. So you might have kind of like 6 or 8 guys who own some portion of the business. There's like one guy who owns, say, like the majority of it, and or then ladies. The rest of them are kind of alone, or ladies, but these are manufacturing businesses. So generally not the ladies. Sorry, ladies, you can do everything that men can. A lot of times better. You just don't spend a lot of time in manufacturing.
I have no comment on that.
That's sexist, isn't it?
Yeah.
Sorry, ladies.
So
I think any ladies are listening to this anyway.
Hey, I think it's like 7% female on my analytics.
That's about what mine is too. Shout out to the ladies
Shout
who
out to the
follow
ladies.
us. We appreciate it.
We do appreciate it.
You really stand out in the sausage fest that is Fintwit.
Also no comment. So when I'm looking, so say I'm an airline, I'm Willows Airline, and Exchange Income Corp wants to buy me with 50% shares, and me and you are business partners in Willows Airline. So now we get paid, like, if it's $10 million we're getting bought out for 50% shares, 5 million. So we each now get $2.5 million worth of shares of Exchange Income Corp. Now, I guess every deal would be different, but is there an expectation now that we're still running the company, but now we just own part of Exchange Income Corp, and that kind of keeps us motivated to make more money, which makes more money?
Well, yeah, and I think that's a win-win for both the kind of the existing managers because they get cash, they get the buyout, and then exchange where they can just say, "Hey, keep running the business just like you were before. Just send the money into Winnipeg."
And I guess, but like, they must run into situations where people just want to retire off that, like when they get
Yeah,
acquired.
I think so, but you I think would still have kind of some of the existing management team that's there. Like, I don't think it's very often that like everybody kind of wants to sell out and then retire. And I'm not sure Exchange would be super super interested in doing those types of
I
deals
guess you would
anyway,
discover that
because
in
it's
due
like,
diligence
yeah, you'd
that.
say, hey, like we want you to stay on for 5 years.
Yeah, and I guess you could sign employment contracts before you would close the deal, or like contingency, like we're only buying the deal if kind of thing. Um, I guess there could be situations where they would just retire and say sue me or whatever, but that's probably doesn't happen a lot. Or if it does, it's your management team is big enough that people could pick up the slack, and you wouldn't be buying a company that the linchpin is one person, most likely.
Also, Exchange is big enough now that they don't have to go after these smaller. You talked about the first deal was like for 4 million, and they used to do these small deals like that, and they don't anymore. They're like looking at, I don't know, $100 million plus now. Decisive, what I talked about earlier, they do go after those smaller deals, and that's probably a bigger risk for them than Exchange.
For sure. And I mean, higher upside, obviously, depends on the company, but obviously, like I'm only personally involved in companies for much smaller than $4 million, never mind, right? So that's the only context I have, but yeah, I don't know. There's a lot of different angles with this whole thing. I'm just going through my notes here. I noticed that when I was doing kind of due diligence, that there's not a huge percentage of insider ownership of Exchange Income Corp, where the founder CEO owns 1% kind of the company, where now I might be just coming from a position of ignorance, but you kind of think of these like founder run companies, Elon Musk-esque sort of thing, where they own giant portions of the company. So I guess kind of twofold. Is this standard that they wouldn't own a ton of it? And also, is that good? Is that bad?
I think it's a standard consequence to continually issuing shares to help pay for acquisitions. And what's happened, I think, over time is some of these companies or some of these guys that have gotten exchange shares, for their companies, or that they're part of the acquisition, is that they've slowly kind of sold those off over time as it's gone along, or that they've retired or whatever. But just like, it's just gotten so much bigger over the years that they've just had to continually issue new shares, and that's probably what's happened there.
Yeah, because I guess like I was looking at a lot of their top people. It's a lot of share-based compensation as well. So you're getting paid, a lower salary and then a lot of money via shares. And then obviously if you have a certain lifestyle that you're trying to fulfill, you got to get the money out somehow. So you sell the shares or whatever. And then I guess yeah, it's an interesting, cause I don't see myself as like owning 1% of my company ever, but I guess it could happen. It's a consequence of, like you said, yeah, every share that you issue, if you're not as the founder buying the same amount of shares on the open market or whatever, or issue then you're going to get diluted and diluted and diluted eventually till there's nothing left, right?
There's also the diversification thing to think about, where it's like you run this company, you're employed by this company, and then you have your entire net worth wrapped up in this company. If something goes wrong, you are triple fucked.
Yeah, that's all that. Yeah, that's a really good point as well. I guess I've always just had so much blind confidence in myself that I'm like, of course I want to own 100% of the shares. Like, that's just a win-win there. But that's also
But
true.
you want all the upside, right?
Yeah. Another thing I was kind of thinking about is like the pressures of being a publicly traded company in this sort of situation, because there's a lot of acquisitions that I would make personally that might not look great on paper, but it's kind of like a trust me bro sort of situation where I'm like, I know there's something here. I can make it work. But when you have to do quarterly earnings reports, sometimes that's hard to get across. Is that just another part of like, you just need to trust the CEO sort of thing?
Yeah, exactly. The That's the tricky part about whether it's running a company, whether it's managing investor money in terms of like a hedge fund or whatever, is that you're at the mercy of your investors. And for the most part, like, it's exchange anyway, it's worked quite well for everybody. Everybody's happy. You look at the stock price over time, it's done fantastic. I think long term, since the IPO, it's up something like 15, 16% per year.
Yeah.
Like, it's done fantastically well. So the management team here has got a lot of goodwill they've accumulated over the years. But sometimes the Terry Smith, who was a hedge fund manager in the UK, did very, very well for kind of call it 10 or 15 years, and it's just stunk the bed over the last five. He's seeing big investor withdrawals, and he's had to make some big changes because he's trying to adapt to this world of, nobody really likes him anymore. So that's kind of one of the difficulties in whether it's being publicly traded or, having a hedge fund, just having to answer to people. In a lot of ways, it's a lot easier for someone like you who says, like, hey, I'm buying this. And, I asked the guy in the mirror what he thought, and nobody else chimed in because nobody else matters.
Yeah. And that's, I won't get too detailed because there's moving parts, but I have a friend who is in the position where they might be looking for like a TSX venture listing for their company. That's as detailed as I can get. But I had a long conversation with him, several hours, about this kind of thing, just out of curiosity, and he was kind of talking it out. And that's one of the biggest things, is like, you can't make short-term or even long-term sacrifices for like the greater benefit, because you just have a stock price to worry about, right? And then you can kind of get yourself in this death spiral where you can't get yourself recovered because you're just going down, 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 down. And now we're seeing stock prices of like tech companies and stuff go down when they beat earnings because they didn't beat it by enough. Like, we're in such a weird, frothy market that I think it's hard to run a company like Exchange that's maybe reliant on, investor sentiment. It's hard to make the tough decisions and to explain yourself of like, well, okay, we need to lose money on this because in 10 years we won't be losing money on it. It's a tough sell, I think, to the average person.
I think it's so incredibly dumb to sell off a stock, to sell a stock because the earnings were only like 98% as good as what the analysts thought they were.
Crazy.
Like that's not investing. That's not what a business owner would do. And so like that kind of stuff just boggles my mind. And in terms of like, whether it's being a CEO or like I kind of look at myself as like a, like I invest my own money, and it's so much easier to be able to stick to your guns and to just do whatever you want if you don't have the distractions of like guys emailing your investor relations guys telling you what to do better. Like I think it takes a special kind of person to be able to just shut all that noise out, especially when the stock keeps going down and down and down, and especially when the stock is doing that and the earnings themselves are not as bad as the stock kind of tells you they are. One thing I like to do when I look at a company is like I'll look at it from like 5 years ago, and I'll say, okay, like the stock is, say it's up like 30% in the last 5 years, which is a terrible result. Like S&P 500 is up what doubled in the last 5 years, whatever it's done. So it's like, wow, that's shitty, that's bad. And then you look at the like kind of underlying results of the company, and it's like, hey, like the stock is up 30%, but revenue is up 50%, earnings are up 100%, dividends are up like 125%. And it's like there's this big disconnect between what the stock price has done and what the business has done. But when you're the CEO and that stock price has gone from 300 to 100, you're like, man, what am I doing wrong here? And you look at the results of the business, and the answer is nothing.
Yeah.
But for whatever reason, investors have decided that you're worth 33%, 50% or whatever less than what you were at the peak.
Yeah, and then you're in a precarious spot because you can know in your heart that you're not doing anything wrong, but if your board of directors decides that you're doing something wrong, you could be out of a job for doing everything right.
And not only that, but if you're a tech company or whatever where you have a lot of share-based compensation, everybody in the organization who gets shares as part of their pay is like, hey, obviously you want the shares to be higher if people are being compensated in shares. So then like internally people start calling for your head. Yeah. And you probably don't deserve that, or maybe you do. Either way, it's a tough way to gotta go through life. And you can see why CEOs for the most part they last like 5 years, maybe 10.
Yeah, so
you can see why.
Michael Pyle being since 2004 of a publicly traded CEO, and I think like basically uncontested. At least the meeting that I went to, all the directors, everyone, when they did the vote, it was just like, any objections, silence. Okay, motion passes. Like it was, everyone's kind of on board with the vision and what's going on. And for the record, the general meeting was in an aircraft hangar, which I thought was very
great
cool.
spot for those guys.
I thought that was very cool. That's basically all the big topics I wanted to cover in regards of this. I guess like the one more thing I wanted to ask was like seeing the pressures of being publicly listed and all this stuff. Is there ever a world where a company like this like tries to go private? Like not really, right? Because they're trying like when you're doing equity based buyouts, that's a tool that you can use that you lose in your repertoire, obviously. But I'm kind of like just thinking like if a company gets so big where now they can walk into Bank of Montreal and be like, hey, can I have $1 billion loan at subprime interest? Now they can be like, yes, please take our, is there a world where that something like that could happen?
I'll never say never, because there might be like a, maybe not a Berkshire Hathaway, but something like kind of like that, where they say, hey, we want to control this and we think that we have a way to kind of like, basically just the same model as Exchange does with these smaller companies. They just buy Exchange, and then it's like, hey, yeah, you guys keep doing what you're doing, and there's a model in there to keep that equity share for these deals intact. Sure, like I'm not going to say that'll never happen, but I'm kind of with you. I think it's pretty unlikely that they do that. I think it's just kind of one of those businesses that works better as a publicly traded enterprise.
Yeah, it's almost like that's one of the tools that they've kind of built the company around, is doing these kind of equity financed deals, which is the way that private equity fails a lot of the time, is they use too much debt and too much leverage to purchase a company, where you're not going to get into that kind of situation with doing an equity deal, because there's no interest payments on that, obviously, just the dividend payments that you owe. But other than that, any other kind of final thoughts that you want to get out on this topic?
I think we covered all of it. I'm sure I'm happy I bought the shares. I can say that. They've done really well for me.
I wish I had more. I think it's a good company, and I've been studying it because I want to this is the direction I want to take my career, is this kind of idea. I don't know if I want to do the publicly traded thing, but I've really been kind of studying Pyle more as a founder, and kind of their whole ethos with acquisitions, and I find it very very interesting. And I think it's the more I learn about it, I think it's a good company. Ticker EIF on the Toronto Stock Exchange. Good dividend growth, and I would give it a buy rating, and that is financial advice.
I'm gonna go with a hold.
Okay, I like
it. Which is also
giant
100% financial advice.
Oh yeah, 100%. It is difficult for me to give it a buy rating when it has run up so much. That just makes me nervous with any asset. Like, I'm also like a gold and silver guy, and stacking's made me nervous recently, just with the giant run-ups in 2025, 2026. But when an asset is good, it's good, but it's just like that mania that kind of makes me nervous about about buying something. But within the context of Exchange Income Corporation, I think the stock price has really reflected a growth of their metrics, their underlying metrics in everything, and then also their kind of future outlook to earn more going forward.
That's it. The rise isn't just smoke and mirrors. Like, the business has gotten better in the last, call it 2-3 years. It's gotten a lot better. Is it, it's pretty much tripled from not quite tripled, but close. Anyways, like, is it that much better? I don't know the answer to that, but is it better than what it was when I was buying? Yeah, absolutely. They're going in the right direction, and I think they're going to continue to go in the right direction. For me, I'm looking to buy stuff that's undervalued, and I think it's, like I said earlier, I think it's fairly valued, which for other people, that might be a good, entry point. What does Buffett say about a wonderful business at a fair price? Maybe that checks off those boxes right now.
For sure. Yeah. Okay, well, thank you for talking to me about this. I think I learned a lot. I wrote some notes too that I want to research more on my own, and then tweet at you at 3 a.m. Asking about. Do you want people to find you, or do you want to just disappear into the ether?
Sure. People can. I'm on the Water app. I am CDI newsletter. Or you can put in Canadian Dividend Investing. You'll find me. My website, CanadianDividendInvesting.com. And I have a podcast with Bob from Talkan. It is DIY Wealth Canada. Just put that into Spotify and you'll find us. By the way, we have to have you on the podcast next year. We'll talk about that.
Let's do it. I'd love to. I'm a big fan of your newsletter. I like the way that you synthesize information is like, I've said it before, it's like good for my my like monkey brain, where you're taking all this big information and you really just kind of get to the meat of it, but not in like a dumbed down way, in like a you're only saying what matters kind of way. And that's why I like a lot of your tweets too, where it's just like what we were talking about Pacerama, where you're just kind of like, here's some metrics, this is why I think it's interesting, and it's like a good jumping off point. So that's why I always recommend you as a good Twitter follow, and I do really like your newsletter, unironically.
Well, thank
free
you,
version,
and of
at
course
least.
you've been
I can never afford the paid version.
You've been kind to share my newsletter over the years. I appreciate that. And the paid version of the newsletter is going away.
Oh.
So everybody, including you, in a few months will be able to access all of it.
Wow. I'm going to be a
Yeah.
better investor after this.
Oh, I don't know about that.
I don't know about that either,
you know,
but
there'll be more stuff to read anyway.
that's true. I scroll too much as it is, but all right. Well, thank you, Nelson, for coming on the show, and for giving unsolicited financial advice. I guess it is solicited if they're clicking on the video, right? Drunk Dividends is me. Figure it out. Drunkdividends.com actually will be live by the time you see this.
Oh.
Yeah. I have it. What day is it today? Tuesday. I have it scheduled for tomorrow. The announcement of it. But drunkdividends.com will be live by the time you listen to this. Whenever I get around to editing it.
Very exciting.
Yeah. Thank you for listening, everybody. Buy the stock. Let's pump it.
Pump.